So welcome to the latest MoneyWise UK podcast. I'm delighted to be joined by Callum Wells of Castlefield. Now, I've known Castlefield for several years, and they offer a range of sustainable strategies alongside multi-asset funds, model portfolios and much more. Now, I've been keen to speak to them and with Callum about the business, sustainable investing, fund labels and what truly matters to Callum and to Castlefield. So we're going to start with a nice easy one, introduction and kind of an intro into Castlefield values. So welcome, Callum. First, can you just give us an introduction to the core values that Castlefield was built on?
Thanks, George, and thank you for taking the time to talk with me today. So at Castlefield, we strive to be the ethical or values-driven investment manager and advisor of choice for our clients and clients today and our prospective clients in the future. You use the language they're built on, so it's probably worth going back and talking a little bit about the genesis of Castlefield as a business. So our founder and our chair, John Eckersley, built the business acknowledging what he felt was a gap in the market. So in a prior life, he worked with a lot of charity mandates and managers. And he felt that there was a better way of doing things, or that he could build a better way of doing things for those type of clients. So the charity business was really the genesis of Castlefield as a business as it exists today. For a long time, John was having conversations with connected parties and philanthropic individuals that really liked what Castlefield did and were wondering whether it would be possible to have their money managed in a similar way. And so over time, the business grew from being a service provider to the kind of third sector, that philanthropic area, more to serving ordinary private clients, if you like you or I. And so charities is a big part of our DNA. And it's still a big part of our business, but it's now a substantial minority of our business. And most of our clients are ordinary individuals that want to do well financially, want to see returns on their capital, but don't want to see that at any cost and have a strong values framework that they want us to represent in their portfolios.
And I guess that value framework is, I know when in the past, when I've spoken to you, the idea of the thoughtful investor, and I know that Castlefields have always emphasised this concept of being a thoughtful investor. I think it's a trademarked phrase, and it seems that, certainly when you were talking the sort of values and the foundation of Castlefield, it feels that it's kind of a philosophy that goes beyond products, services, but it kind of shapes everything you do. Can you kind of explain what it means in practice and how you quantify it, and perhaps maybe share some examples of this in action?
Of course, I'd be delighted to. So I guess in a sentence at the outset, I think it means being considered, being deliberate in everything we do, and that, to your point, that goes beyond just what we invest in on behalf of our clients. To be honest, it boils down to the furniture we buy in the office, the coffee that goes in our coffee machines. It really is pervasive. I've been slapped on the wrist more than once, actually, by people internally by attaching documents to emails, or I could send a link instead, which has a far lower level of embedded carbon, which was a surprise to me when I joined Castlefield. So I suppose to answer your last question first, it's an example of how we live the values that we espouse to and on behalf of clients. We describe ourselves as offering values-based investment from the perspective of being a values-based organisation. And that's what we mean by that. And so practically, it all starts with clients. So a really deep understanding of where our clients are from a values perspective is fundamental to what we do. That's kind of our reference point, or our datum when we're building a product set or a service range. And there are a couple of tools, processes, policies that we have internally that help us to, once we've understood those values, help best represent them in client portfolios. So we have what the industry would call an integrated ESG approach. We use the acronym BEST, which is to demonstrate superior business and financial outcomes in portfolios, respect environmental and ecological concerns, social concerns, and build a portfolio that has the highest standards of transparency and governance. And so that's largely our way of saying we want fantastic return opportunities for our clients, but in a way that minimizes harmful negative externalities. And again, I get a bit of a slap on the wrist when I use language like externalities, because it's slightly jargony in an industry that is unfortunately beset with jargon. But I really do think it is a perfect way of describing how we think about investing on behalf of clients. We really do want to deliver the best risk-adjusted financial returns we can for our clients, and clearly they want that too, but not at any cost. So we have to be very careful that the portfolios that we build for clients avoid that process of externalizing cost or dumping cost on other stakeholders, whether that's broader society or the environment.
And I want to explore a little bit further down around ESG, sustainable, responsible. But when you kind of touched on this a little bit about your kind of the way you think about it, but can you kind of take that a step further and go and explain your investment approach? Specifically, I'm thinking about the management style you've adopted and what this means for investors, because as we go through this, there's going to be some stuff that we talk about and unpack. So it'd be really interesting for you to sort of start that part of it, but also how you report on progress, how you engage with companies, and the challenge perhaps that of the companies. So some people might invest in a company, I guess, and say, yes, we engage with them, but they don't do anything about it. So I guess there's those sort of challenges. So that's kind of quite broad, but I guess it gives you an opportunity just to kind of talk about your approach, how you engage, how you report, and what it all means for people.
Absolutely. So there's lots to go out there. So if I miss or forget one of those, please do prod me and I'll come back to it. But on the investment approach, so we are long-term, fundamental, bottom-up investors, which I think is a bit of a cliche, to be very honest, in our industry. But there's a good reason why that style suits us. Typically owning what we consider to be the best companies globally, leaders in their field, obviates a lot of the risk around those externalities. Generally, good companies are good in many dimensions. It's a bit of an oversimplification, but we find it's largely true. And so we do ourselves and our clients a lot of favors by not trying to perhaps be too clever and to play around in parts of the market where there are lower quality businesses that perhaps could drive a lot of improvement across every dimension, the business and financial or environmental or social. And that's also not where our clients want us to be, which is fundamentally important. They understand, as do we, that a lot of positive change can be brought by owning businesses that are perhaps not the best companies in the world today, but have the potential to improve. They generally are just not comfortable owning businesses that are operating or performing below what they see as a certain standard. And so the reason that approach really suits us is because we tend to want to invest on behalf of clients for the long term. We're not wildly active. We aren't repositioning portfolios from one week to the next to try and take advantage of different movements in markets. We like to invest through various cycles and, as I say, just let good companies do the hard work and compound earnings within the portfolio. And I think that lends to our strengths. We have a fairly deep research capability internally, but ultimately we look after a lot of individual private client portfolios, and there are tax considerations and there are various other reasons why we don't necessarily want to be turning over portfolios very quickly. So that approach of trying to find and underwrite the best businesses in the world, buy them and hold them for the long term really does work well for us. There's also the non-financial dimension of it, which kind of leads me nicely into one of your other points, which is engagement. We would be a poor partner for our investee companies if we were jumping in their stock or effectively not really engaging with them like a proper partner would or perhaps ought to. And so we get a lot more credibility from them. We get a lot more attention from them by being long-standing partners of them. And that really does help with everything we try and do on the stewardship and engagement side. So you did ask about that, so I'll perhaps elaborate a little bit more there. Generally, we have a process every year where we establish at the outset what our goals are broadly for that year. So if you think about it like a thematic engagement work stream, whether we're talking about something like net zero or conflict minerals, which have been the two big thematics that have been in place since I've joined the firm, which was about 18 months ago. And then we have stock-specific thematics. So there may be a particular point of governance that one of our holdings is we feel weak on and we would like to see them improve, or there is a particular policy or product or service decision that we think our clients would be either uncomfortable with or would like to see us push for some positive change on. So it really is that sort of a bifurcated approach between those two, a broad thematic that we tend to apply uniformly across our portfolio companies. And then we will pick company by company, issue by issue, things that we wish to engage with them on, and we'll follow our engagement processes there. I think there may have been one or two more things that you wanted me to touch on.
Yeah, I guess what naturally falls out of that idea of engaging is how an investor can see what you're doing. So it's about how do you report on that, and maybe it might be quite useful just to have an example of where you have actually engaged with a company and what that actually means. Because I guess to some people, you'd like to think that a lot of people listening to this will know exactly what that means, but it would also be useful to perhaps just give us an example of where you have engaged.
Of course. So on the reporting side first, that's really topical at the moment. So quantifying sustainable finance, I think, is a really hard thing that the industry has been grappling with for a long, long time. And we've had engagements that are actually relating to that. So we were investors in Britvic for a long time. The business has just been taken over. It's been taken over by Carlsberg. So we wouldn't be investing in the new entity for, well, say for obvious reasons, but it's probably worth making the point that we don't invest in alcohol as part of our ethical constraints. So one example of a specific engagement there was on CSR, or corporate social responsibility data reporting. And we had a really good partnership with Britvic, actually, who were committing to publish data on things like the amount of virgin plastic that they used in their packaging processes. And it's actually quite a nice two-way street, because I remember that particular example. They felt comfortable enough with us, and I do take this as an endorsement of what we do. They felt comfortable enough with us to express their frustration of our industry, if you like. They were being told almost weekly by investors that they now wanted to see X metric or Y metric reported. And of course, that layers a lot of cost into the underlying businesses that we invest in. So there is a good reason for us to consolidate as an industry around a set of standards. And that hasn't really happened yet. The EU is making a decent amount of headway in delivering some new rules and regs that will help with that. And I'm sure we'll get to talk to that and to touch on that later. But that was one example. We do and have reported what I would call the major metrics, so things like gender diversity on boards or independence of boards, weighted average carbon intensity of revenue, similar metrics for waste production and water consumption, so how wasteful or how much water do businesses consume per unit revenue, just to really give investors a feel for what the outcome of a Castlefield portfolio looks like relative to a peer group or relative to a benchmark index. That's something that I think is going to improve a lot in perhaps the latter half of this decade, but really we aren't there yet. And I know that we'll touch on this later in the podcast. But another way that we report to clients, as you probably picked up, we value the highest standards of transparency and governance in our investee companies, and we try and hold ourselves to the same standard. So things like our voting record, we have, certainly all the time I've been here, which hasn't been that long, but also well before it, as I understand, we've published a public record of our voting so that clients can see exactly how we vote in every ballot for every company, and we commit to that on an ongoing basis. We also publish our stewardship report, which gives investors an idea of the scope and scale of all of the work we've done throughout the year, and some detail on exactly what those engagements look like, touching on those thematic pieces and touching on a few stock-specific examples. There's currently one that I'm involved in at the moment that's very much live. So we're investors in the Renewables Infrastructure Group, which is a London-listed investment trust which owns a broad portfolio of renewable energy technology. And I don't know if you'll have seen, but they recently renegotiated the underlying investment management fee with the investment manager of that vehicle, Infrared Capital. And we felt that the terms were not in shareholders' interests. The aggregate of the change, there were parts of it that we did support, there were parts of it that we were okay with, but there were some parts of it that we felt we just couldn't support. And this is an ongoing engagement. I've got an email that I sent to the board earlier today. We've interacted with other shareholders on the register to make sure that we're not wasting the board's time, but also we're collaborating for maximum effect so that we can present to the board something considered and congruous list of requests from an entire group of shareholders.
So you just touched a little bit there on your engagement. You talked about renewables, infrastructure. You talked about your stewardship report, your voting records. So those are all means that you report back. Is that right? And are you often quite open in your active discussions? Because that's quite unusual to hear, actually, is that we often just see that kind of stewardship report or we hear about the stewardship report, but we don't often get that kind of openness that you've just given to us.
We'd be that open with clients. I don't think there's anything there that I wouldn't be happy for us to make a public position. My compliance team may take a different view when they listen to the recording, and they might want that bit X'd out. But generally, again, that point on transparency, we like to hold ourselves to the highest standard of transparency. It's not a position that we feel that we need to hide from. We're engaged, and it ought to be said in that particular example, the board are engaging really constructively with us. They're listening, they're responsive. It's not escalating in any sort of unsavory or antagonistic ways. And it's not a particularly controversial position within the industry. As I mentioned, we've spoken with a few other holders on the register, and we often find that's helpful to amplify our voice. We're a relatively small shareholder on any register. And so finding like-minded shareholders to advance our cause and to engage us in advancing the causes of their clients, we find works in everybody's interest.
It's interesting because as you talk through and you talk about the thoughtful investor, and we've got this kind of very kind of a feeling of an ethical approach. And probably the next three questions kind of play on that. And the first one's kind of much more open and much broader. And then we're going to go on to the regulatory labels. And then we're going to talk about the impact of all of that on Castlefield. So there's kind of a journey that we're hoping to come through. And I think the first one is that there seems to be a lot of confusion around labels in inverted commas. So you hear terms like ESG, sustainable, responsible, impact, ethical. Ethical perhaps is kind of the old way that many people will have heard. ESG is perhaps something that some people might call a sort of a fad that just has appeared. But, my argument is that every fund should incorporate ESG factors. But then we get this kind of contradiction. So you get something like the FTSE for Good that appears to hold oil and mining. So then you question, well, what is that? Is it ESG? Is it, and so it would be interesting to your thoughts kind of more generally around how you approach these different labels. I know that you have in the past used sustainable, you've talked about ethical there. And do you feel that there is perhaps a way away from, because obviously we're going to talk about labels and everything, but do you see there's a way to simplify this landscape, and how would Castlefield possibly position themselves within that?
It's a really good question. I think one the industry's probably not solved very well. Part of me wonders whether, I'm sure some simplification is possible, but whether more simplification is possible or desirable, or a greater deal more. Sustainable finance is a massively broad area that touches every part of the world and every industry in one way or another. Something of that scope doesn't necessarily need to be simple. In fact, I'd probably go the other way and say there's a lot of complexity for any investment manager or client advisor to try and distill, actually, for a client who doesn't want to be entirely overwhelmed by what it means to engage in sustainable finance or engage with sustainable finance. I think of it and message it as something of a spectrum. So you start with unconstrained investing at the outset, where you're simply solving for one thing, which is maximizing risk-adjusted returns. And then if you go across this spectrum, which starts from a kind of a dull grey, goes through into light green and to ever darker shades of green, something that probably starts with ethical investing, that sort of commitment to do no harm, to avoid investing and supporting industries that one doesn't personally agree with, and go all the way through to responsible, sustainable, impact investing, and then ultimately in philanthropy, where there is no requirement for risk-adjusted returns. Ultimately, the objective is to give it away to try and make the world a better place. So on the x-axis, we understand what that looks like. On the y-axis, that's where I put risk-adjusted returns. And at Castlefield, we like to try and position ourselves at what we see as the optimal part of that curve. So we want to do as much good as we possibly can, acknowledging that that's a fairly nebulous concept and we can dig into it a little bit more, without giving up risk-adjusted returns. And the big risk factor, as I see it, for sustainable investing is that concentration. It's concentration of styles, of factors, of holdings. And it may be perfectly reasonable to deliver a portfolio with an identical return profile. But the more one narrows their investable universe, in theory, in pure theory terms, the more risk is being courted by that portfolio. So a higher returning portfolio is likely to have a greater amount of risk than an unconstrained portfolio delivering similar returns. And that risk pickup is almost exponential as you go across the sustainability spectrum or the good spectrum. And so there is a point that we like to feel, or we feel we occupy, which is not giving up a tremendous amount of risk-adjusted returns, because we still have access to a lot of the investment universe. I was answering this question for a client recently, and I think our ethical screen sits atop of our portfolios, and that probably rules out about 15% of the investable universe by market cap. So we can still go at 85% of the investable universe. Then that shrinks down again when we're looking for businesses that don't dump a lot of cost onto the environment, or businesses that don't dump a lot of cost onto society, those businesses that are well governed. And then ultimately there's the financial dimension and trying to find the best companies in the world. That probably narrows our investment universe more than the other factors. So to answer your question, that's how I imagine and that's how I message to clients the universe of sustainable investing. And those terms, I think, do mean different things to different people. So you touched on ESG being something of a fad. If I were to speculate, which is probably dangerous, it would be in the last decade, with sustainable strategies doing very well in performance terms and doing well in terms of gathering a lot of assets. There were a lot of unconstrained or conventional strategies that felt as though they were missing out. So in order to try and force a square peg into a round hole, they were articulating something that they had always done, which was focus on the financial dimension of environmental risk factors or social risk factors or governance risk factors. And they do all exist and they always have. So if you think about social media companies and the risk to revenue and profitability that comes from regulation designed to protect society from some of the harmful effects of social media, one could be an unconstrained investor and still focus on that as a risk. And then that would fit the bill of being an ESG investor. But it's all done from that singular perspective of trying to maximize shareholder returns. rather than that broader perspective, which is what we try and occupy at Castlefield, which is, yes, thinking about what the best thing for long-term shareholder returns is, but also to satisfy the values position of our clients, making sure that that doesn't come at the cost of stakeholders or numerous other stakeholders along the value chain.
It's quite interesting. I've never heard anyone describe ESG in that way. I think you're right. It's almost like ESG, there's two aspects to it, but we kind of see it as one. So the two aspects, as you say, is one is it's all about the financials. So it's less about, and so within that, you could have an oil company or could have a miner, but then you've got this ESG that has exclusionary, and it's almost like the industry has just put everything into big one big pot, but it's more nuanced, and that possibly is where this confusion is coming. Would you say that's fair?
Yeah, I think so. I absolutely agree that it is nuanced, and that kind of gets back to my first point, which is I don't know how far down the path towards simplicity we can go before we actually start losing some of that important nuance.
Mm.
And you started the question with, how do we think, what can we do about it? This is something that I'll touch on again later, but one of the things that we felt enormously privileged about at Castlefield is that we enjoy the trust of our clients, particularly on this values-based side. And so where the regulatory imperative at the moment is pushing the industry towards some kind of quantification or standardization, we haven't necessarily felt the need to build that historically, because we rely a lot on judgment, our own judgment, and our clients trust and respect that. And generally our clients espouse their values position to us at the outset. And over time, we have a relationship with them, and that relationship builds trust between Castlefield and their clients. And they know that whether we call it ethical, thoughtful, or sustainable, that we're doing what they want us to do. And that's probably the most important thing, or in fact, is absolutely the most important thing from our perspective. But we're quite lucky in the sense that we have a direct relationship with almost every single one of our clients. If you are an institutional asset manager and you sell your fund broadly and you have no idea who's on the other side of the table, if you like, it's much harder to do that. And so I do have some sympathy with the need to badge and to label, and it perhaps doesn't fit our business, but we are a small business and we're perhaps not a typical business. So it doesn't necessarily surprise me that the shape of that regulatory imperative is one that might suit a larger, more institutional asset management business more so than it does us.
We saw coming across from Europe these regulatory labels where they had 6, 8, and 9, and then you've got the FCA bringing in their own labels, and it just muddies everything even more, because I've spoken to firms who are Dublin based, so they're seen as offshore or European, and therefore they're subject to the Article 6, 8, and 9, and they're less worried about the new FCA sustainable labels. And I get, to some extent, I mean, as we've just talked about, this idea of all these different or names around things, is you can see why the FCA wants a unified framework. But I guess, I mean, you've had to work with this because obviously your funds are sustainable. So how has this labeling been a challenge or opportunity for you as a business, and what route have you taken, and why?
So the challenge for us, as I mentioned earlier, we're a relatively small team, and the sort of compliance and verification burden was substantial when won't shy away from that. And this is, I think, something that I was getting at earlier. We've been in a really privileged position of client trust, and in so many ways, way beyond sustainable finance, we're entering this new trustless world. And so initially it seemed like a bit of an exercise in showing our homework. The way the regulations were designed, the intention behind them, I think was absolutely laudable. It felt, when I first read the SCR policy paper, that the regulator were really genuinely trying to make space for the diversity of thought and innovation within the sector. And I always advocate for my own sector because I think the industry did actually a really good job of evolving sustainable finance through, as you described earlier, a fairly simple exclusionary process to something that was much more considered, much more deeply integrated. And they did that entirely without a strong regulatory imperative. So that's something I think the industry does deserve credit for and acknowledgement of. I think the challenges we saw with SDR were more based around implementation. And I think that was the regulator getting comfortable with the practicality and the breadth of challenges and the breadth of market participants faced in doing things like quantifying sustainable investments or what a good outcome or output of a sustainable portfolio might look like, whether it is through environmental metrics or social metrics, etc. And so I think it's gotten to the point, I mentioned the industry evolved well, it's gotten to the point where the industry probably did need that arbiter and did need something to try and, I don't want to use the word commoditize, but standardize processes and approaches so it would be a little bit more digestible for clients. But I'm just not sure we were there in the broader economy, frankly. So we face challenges around gaps in data. And now I think any participant in this industry will just acknowledge that they exist. It's an imperfect world. You might invest in 10 companies, use the same framework, whether you're assessing things like carbon intensity or waste, and you'll have one company that doesn't produce a metric, or that metric might be estimated. Estimated data is something that we are challenged with often. We subscribe to several different data vendors to supplement our own research. And the amount of times that we've consulted 3 providers and got 3 different answers for what is the same question is remarkable. And so I think the regulator initially came at it from a position of either perhaps hoping or expecting that data was better than it is. And it was a heavily quantitative approach that it became clear that the regulator was looking for in that implementation period. I think that's since softened. So obviously we saw a limited amount of success in terms of the whole industry engaging with the labelling regime. And that anecdotally, I've heard the kind of challenge that comes from the regulator when trying to get a new fund labelled has softened somewhat. Again, the regulator has had more chance to interact with industry and to hear a bit more direct industry feedback. So I guess it's a really long way of saying I think it's absolutely an important thing to happen, but I don't envy them the challenge of what they're trying to do. For us, the approach we've taken, initially we did go down the labelling route. So as I say, we read the policy statement, were pretty sanguine about the implications for Castlefield as a business, and that was our position until the implementation process. We got started in earnest with the implementation process. We were having a lot of calls with our ACD, so we don't have an in-house ACD. We think it's a good point of governance, actually, that we don't. So we had a third party kicking the tires on our broad sustainability approach or thoughtful investment approach, as we call it. We had their lawyers doing exactly the same thing. And again, it was sometimes falling down through incomplete data from our underlying portfolio companies. And we were almost being pushed into places we knew didn't make sense, like divesting from a company because they didn't provide a single metric or something like that, or changing and defining our investment universe based on criteria that we hadn't had the time to fully understand and underwrite the implications of. And so for us, it felt sensible to go into what we call the naming and marketing rules, where we can continue to do what we've always done. We just don't have a label, and then we aren't allowed to use any of these protected terms, of which sustainability are examples. And so ultimately, I think we would absolutely like to re-engage with the process, but there's so much change going on at the moment. We want to make sure that we can be considered and deliberate about what we actually do when we re-engage with the process, because ultimately we're satisfied and our clients are satisfied that what we have been doing is exactly what they want us to do. So we haven't changed our approach, so we don't feel there's any client risk. And I think it's also worth saying we have evolved our approach over time. So we started life, as you've described it, in that sort of ethical space where we had a portfolio with a set of negative screens at the start of it, and that satisfied a lot of clients. And we've built out this integrated ESG approach that doesn't simply focus on good financial outcomes, it focuses on broader stakeholder outcomes as well. We went through an exercise of teasing out the positive portfolio impact for client reporting purposes. So to be really clear, we're not an impact fund or manager. We've never messaged ourselves as such, but we do acknowledge we invest in companies that an impact manager would consider to be an impactful investment, like Vestas, the wind turbine manufacturer, for example. And it was in response to client demand. We were teasing out some of the positive stories of our portfolio companies and reporting that to clients. And so we have evolved, but that evolution has always come through the client imperative. It's what our clients have wanted, whether they've told us explicitly so, or whether that's something we've realised from our close conversations with our clients. This was the first time we were focusing on changing that thoughtful investor approach, that really meaningful part of our investment process and philosophy, satisfy a regulatory imperative. And I think it's a big challenge. Hopefully we've got time to talk about the ins and outs of SDR. We think it's a big challenge, and we will ultimately rise to it. That's a standard that we set ourselves to meet. But we don't want to do it flippantly, and we don't want to do it thoughtlessly or carelessly. And the decisions that we make, have real impacts and have real implications for real people's portfolios, real people's invested wealth. So again, for us, it just felt appropriate that with all this change and far, far greater amount of uncertainty than we've seen in the industry for many years, that taking a breath and sort of consolidating in what we do, what we know we do well for a period of time made sense. And we are, I think, already seeing a refinement of what the rules meant in some cases and what the implementation ought to look like in some cases. And so I think we'll ultimately be in a better position in future.
I think it's funny because I know that you're not the only company that has gone down this route. And, when I look at your brand and you've had to remove the word sustainable. And I know that you've talked a lot about your approach, how you're in all but name, you know, that's what you do. But obviously you can't promote that way. So you've been able to stick to what you do, but then you've had to change or slightly shift your branding. Does it make it harder to market your proposition now because you don't have that sustainable label? Or is the thoughtful investor or such a strong brand in itself? It must make it quite a challenge for you because although you have protected your process, you've had to shift your branding and how you market.
That's absolutely fair. And for what it's worth, I think I really liked sustainable or sustainability as language. I think it does encapsulate what we do quite well. As I said at the outset, we focus on those negative externalities and avoiding them, not just for financial reasons, but for broader societal and environmental reasons. So to me, sustainability, that idea that something can perpetuate or can persist into the future indefinitely, because it's not vulnerable to those kind of negative shocks or externalities, is what we're aiming for. So I do think, to a certain extent, it's been damaging to that marketing push. But growing our business and managing a successful business is absolutely important to us, obviously. It's secondary only to doing the right things for clients. So that's why we've made the decisions that we've made. Ultimately, I don't know how the evolution of our brand will unfold, to be honest with you. That's questions that we're actively talking about. At the moment, it's fairly moot because we do need to go through the labelling process when we feel that it's appropriate for us to do so. I wouldn't say that the thoughtful investor brand is sort of something that we can necessarily stand on entirely. We are, as I mentioned, we're a relatively small player with something of a boutique in the space. So I don't think people would be searching for or screening for thoughtful funds in that sense. And I do think sustainability, to answer one of your earlier questions again, was getting some traction as a somewhat catch-all term, as a broad bucket. It was an imperfect description of what a lot of people did, but it was a kind of common balance. And so possibly it does, but I say ultimately doing what we think is the right thing for clients is our North Star. It always has been and always will be. So if it makes it a little bit tougher for us to tell our story, that's not great. Perhaps it makes our story a little bit more differentiated, our story a little bit more engaging, and ultimately makes people pay attention a little bit more, which might serve as an advantage in the fullness of time. So it is for us to make the absolute best of it that we can, of course, as it always is. Right now, it's not having any implications. So the labelling regime was built for investor understanding, to make it easy for retail investors to access sustainable products. And so
I think one of the most interesting things is that in all of this discussion and talking to you and thinking about it is that, you know, if somebody goes on to a filter to look for sustainable funds, even before this was here, it was often actually really, really hard to pull out sustainable funds. You know, whether they've got a label or they haven't got a label, what's going on at the moment isn't necessarily making that easy, is it? So I guess if you've got a brand that you've built and you're out there, you can keep talking about it, can't you? I guess.
Yeah, that's absolutely true. And as I mentioned earlier, we're at this stage at the moment where it's so new that people aren't necessarily looking for it. IFAs aren't saying we're only going to buy labelled funds. Retail clients, expanding what I was saying a moment ago,
yeah,
I hadn't heard of it. It's designed for them, but it's not on their radar. They aren't looking for the FCA's label. So that may come with time. It's new. At the moment, it's not a disadvantage to us because nobody's looking for those things. And ultimately, we may very well have a label by the time it becomes more standard, whether we would continue to describe ourselves by our proprietary process and philosophy, or whether we'd try and make ourselves more accessible by using common language. Again, that's a marketing and messaging decision for people that are cleverer at those things than I am to make. But really, I'm just focused on doing as we always have, which is what I think is the best thing for our clients.
So we've talked about SDR and we've covered all different areas. One of the things I'd be really interested is if there are any kind of specific challenges that perhaps you're aware of or you've seen, because obviously when I did the introduction to this, we talked about the fact that you run your sustainable strategies, which are, as we know, are no longer called sustainable, but your multi-asset funds, your model portfolios. So it'd be really interesting to see if there's any examples of challenges that you've had around those areas.
That's an absolutely fantastic question. That's probably one of the areas we've seen most challenge, actually. So with SDR, intentionality was a big part of what the FCA were trying to get at, as I understand it anyway. And so being deliberate about how one invests to meet or achieve a specific predefined sustainability outcome. Now, for certain funds, that's really easy. That's an eminently achievable thing. Something like a climate assets fund or a water fund or something that's heavily thematic. In fact, that was one of the early concerns about SDR, was that it tilted the industry toward thematics, because it's quite clear to articulate what you're trying to achieve there. and then how every investment contributes to that end goal. With multi-asset, particularly the part of the market we're in, which is what I call open architecture. So we use some of our own strategies. We also interact with what we think are the best and brightest in the broader sustainability franchise to deliver client portfolios. It's often not the case that there is a single neat, tidy, coherent, overarching sustainability objective that one can define that incorporates what every other fund that one might reasonably own does. And so that breadth of sustainability objective is something that I don't think is well catered for in SDR at the moment. I think the regulator are aware of this, which is why they've delayed the implementation of SDR for MPS or delayed further guidance on the implementation of SDR for MPS. And so that's something I would love to see solved. And I think that's something that we'd absolutely need to see solved before we sort of took up the fight again and tried to get Castlefield portfolios over the line, because without that, again, we are going to need to tilt client portfolios in a way that we wouldn't be comfortable from an investment perspective in tilting them, and we wouldn't have otherwise without that regulatory imperative. And I think it's something that is really quite important as well, because I'm gratified that so many people in this country want to invest in a thoughtful, considered, sustainable way. And ultimately, for me, the most sensible way for somebody, for a relatively unsophisticated, perhaps retail investor, the kind of investor that would have to rely on an investment label to understand what a good sustainable product is versus perhaps a not good sustainable product, there's a real risk that they end up in an incredibly tilted, heavily thematic portfolio that might do wonders for their non-financial objectives and outcomes, but would be a really, really hard to support core multi-asset portfolio for your average client to own. And then you get into this realm of trying to follow that through and what implications that begets for that client. So recently we've seen a really uncomfortably long stretch of underperformance for sustainable strategies, for instance. One of the biggest risks in investing generally is to lean out of something when it's not working, when it's the nadir of a cycle. So cycles exist in investing markets, always have, always will. We saw a tech cycle roll over in the noughties in the 2000 to 2010 period. The last thing you wanted to own in that period was tech, and exactly what you did want to own was heavy assets in industry like oilers and miners. And in the 2010s, that reversed, and you had this really strong period for tech, and it was an awful period for any kind of capital intense heavy industry business. And so something that risks exposing a relatively unsophisticated client to a really strong stylistic investment position also risks them having a really bad journey and then leaning out of it at exactly the wrong time. And frankly, destroying the motivation of what we would consider a well-aligned, considered client. Leads to thinking along that line of it is only philanthropic capital. You cannot invest in an impact way or in a sustainable way or in an ethical way and hope to achieve returns at all. That's simply not true, and it was borne out in the last decade. And I acknowledge we're in a tough period for the style, the sustainable factor, if you want to think about it in those terms. But I absolutely do believe that it is cyclical, and as I say, it's important that clients who are perhaps earlier on their investing journey are invested correctly and in a way that's considerate of that and won't put them off investing for life and won't put them off sustainable investing for life. And ultimately, we think that's what every client should do. I've said this often to advisors that I talk to. For me and for Castlefield, we think that at the moment, there's a risk that sustainable investing gets turned into this really, really small, really well-manicured garden with very high walls. And it should be the opposite of that. It should be a national park. It should be open for everybody. It should be very organic. It should evolve very naturally. And that's what it has done hitherto. So I'm hopeful to see perhaps not a change, but a recognition that making this the broadest possible church is ultimately what sustainable finance needs, because frankly, we need to crowd in as much sustainable financial capital as we possibly can.
Yeah. And it's really interesting actually, because I guess that whole, again, going back to where we're leading to or what we're trying to achieve with those, with the labels, and then how that kind of impacts your multi-asset, your MPS, and then also, if it makes it harder for the clients to invest in sustainable products, then have we succeeded in what we're doing?
Absolutely. We're getting to a much better place with it at the moment. Say, if you'd asked me a couple of months ago, it would have looked like limited success because there were relatively few funds that had labels. They were heavily thematic. As a multi-asset portfolio manager, I would have held that it would have been pretty much impossible to build a sensible, balanced portfolio for clients, and so they would have been left with this really quite extreme stylistic bent in their portfolios that I don't think would have served them well in the long term unless they were very sophisticated investors and knew what they were doing. And the paradox there is that that's not the type of investor the labelling regime was designed to cater for. So
Yeah, and kind of as I wrap this up, I think it's been really interesting because I think going through that kind of the build up to where Castlefield have come to, kind of this whole positioning around the responsible, um, the labels, etc., sustainability, and then the impact on Castlefield. That's all been really, really interesting. I'd love to hear your perspective on why you think it's essential to be thoughtful about how we invest today and in the future.
so for me personally, it's a really easy answer, and I know it's very cliche, but with my wife and I just not long ago had our first child, and there's that kind of Damascene moment that occurs after being a parent for the first time. So your time horizons lengthen massively because I'm no longer worried about the world that I'm going to live in for the rest of my life. I'm worried about the world that he is going to live in for the rest of his life, and then generations beyond. I think there are so many reasons why it's important to be thoughtful. One is that it's so easy to detach or divorce the outcomes from our actions in this increasingly complex world. One has to be really considered in thinking about the onward implications of everything we do, even those little things. And ultimately, it's a really exciting world at the moment, as I see it. Progress is in many fields is accelerating at an almost frightening pace. So spend a lot of time thinking and looking at the tech industry, semiconductor industry, and the evolution of AI as a nascent industry. And it's really easy for me, somebody who's sort of conditioned to and trained myself to think in long-term horizons, to see what this will compound into in the future. And that's exactly the point. Progress does compound. And so any little thing we can do now builds upon prior progress and so into the future. So if we want to solve for what I imagine any reasonable person's wish for the future would look like, which is kind of global health, happiness, prosperity, and freedoms, then I think focusing on it's hard work, but being thoughtful, being considered about the little things we do, about every decision we make today matters and inches us closer to that future. And it's hard, and progress may be almost invisible to see at the moment, but it will be so vast and so it'll be impossible to ignore in the long run.
Yeah, I like that sort of progress does compound. And I think that's, kind of makes you think that the smallest thing that you can do, if everyone does a small thing, then it compounds and it gets bigger. So, and, there's other things that you've said today that, it's just been fascinating. I enjoyed kind of almost splitting ESG as well, and just kind of never really thought about it in that way. And just the whole discussion has been fascinating. So thank you so much for that.
No, thank you for your time.
Hopefully,
Thank you for having me on.
I know, absolutely brilliant. And as I say, I know that it was difficult because you were going through the change of where you were going. And so the fact that we've been able to sit down and have this discussion, brilliant. So thank you. For anyone who's been listening, if you want to know more about Castlefield, if you visit their website, castlefield.com. And then to our listeners, don't forget to follow MoneyWise UK for more insightful and topical podcasts coming soon. Thank you very much.